Okay, all right. Surya Jasvi Nama to all the Surya Jasvis who joined on this sunny Saturday, Sunday afternoon to the Soul Podcast. Hopefully, the day is going well, and this is going to be a session which is going to be quite useful for all of you. Hopefully. All right, so let's begin. This is the last session that I'm probably taking on the wealth series, and uh, this is, and there were, that there have been already 3 sessions on the wealth series. This is the last one to address any questions that people may have on uh, whatever we discussed in the past. Any questions, clarifications, and so on and so forth, which you have or which you think will be useful for others. I'll be happy to take those questions. All right, so let's begin. Who goes first?
Sir, I have one question.
Yes.
You in the 3 sessions you explained beautifully about the investment plans, what is investment, what is the usefulness, and all those things. One thing I'm just checking, because you know very well that land is always appreciating value.
Okay.
So if we go for investment in land, not for building a house, it's like for a business purpose, like a real estate type.
Yes.
So is it a good investment for a long-term plan, or if we have a money, so we can for 10 years, 15 years, we'll invest in land and keep it as it is, and after 15 years we go for sell. Is it a good plan or no?
Okay. So the so land is an asset class. Real estate is an asset class, just like gold, just like stocks, just like mutual funds or ETFs and so on and so forth, or even currency for that matter. People may say that a dollar continues to appreciate, so why don't I keep buying dollars? And then the dollar appreciates, and then you can sell the dollars, and so on and so forth. Land similarly is an asset class, and like any other asset class, it is not correct to think that it will always go up. There have been times when the land prices depreciate, even rentals depreciate. Just like this is a common myth which people say that gold and land will always increase. Not true. So look at the 2008 US crisis. Why did it happen? And you know that there were houses which were sold, $1 million. I think houses which were worth hundreds of thousands of dollars were sold for as less as $1 or $100 or $800.
Yes.
Why did that happen? Because the land prices crashed. Why did land price crash? Because there was no buyer which was available.
Right.
Okay, and then banks they took over those loans, and then they did then they sold them off for whatever bid they could get. So people even made money in that case, but it was on people who were buying it at very throwaway prices that made money. But the fact is that the 2008 crisis really happened because real estate crashed. Real estate crashed because earlier real estate had grown. It was a real estate bubble because people were pumping in money. Those people who didn't have the ability to pay the EMIs were being given what was called subprime loans. So there was just a huge bubble, a real estate bubble that was created, and because of which it later on, when the bubble got punctured, land prices crashed. Things like that happen over here also. So there are going to be times when land will appreciate. There are going to be times that land will depreciate. But land or real estate is likely to real estate is fixed fundamentally, right? It is an asset which, just like gold, let's say lithium, for example, there's only X amount of it which is available. So as long as the population continues to increase, land price will appreciate, which is in the foreseeable future. It may go down sometime, some years or whatever, but over a period of a long-term horizon, land is likely to give you is likely to appreciate, just like inflation. But this is in India. Now imagine if you were, let's say, in Europe. Would land appreciate over there?
No.
Why not? The reason is, or let's say in Russia, the reason is, or in Japan for that matter. So the reason is that while land is fixed, the number of buyers for that, or even in China, for example, the number of people who are being produced, consumers, they are going down. India is one of the few places where land will continue to appreciate for the next 30 years. Why? Because there are the population is getting added, the available asset is less. Similarly, so the real estate is considered to be, as an asset class, a defensive asset, just like gold. So there are times when people say that gold will always appreciate. That's not true. You go look back gold prices, you will see that there are times when it goes up, there are times when it goes down. But overall, over a period of a decade or so, there would be times when it would show a general increase. So it is a good asset class which will allow you to, let's say, beat inflation. Now, the good part about, as we talked about in this thing, so should we buy land or gold or no? I think typically land and land as or real estate as well as gold, they give certain returns, and what you should and this varies from place to place. Let's say Gurgaon for a long period of time was very, very hot. Bangalore was very, very hot. What is going to continue to be very, very hot? So where you should be mindful of that. It may not be true that Gurgaon or Noida or Bangalore will continue to be hot. If they reach a certain level, it is likely that there would be some plateauing out, or maybe sometimes a crash. Okay, so what you should look at is, like any other investment, whether it is a stock, a share, a mutual fund, or whatever, you should look at what the past performance of that asset class is year on year, and there would be some real estate prices which you will be able to get, and then determine whether you want to go in over there or not. But fundamentally, I am against the idea of buying real estate. A real estate mutual fund or a real estate ETF kind of a thing, if it is available, it is far better proposition. Why? Because it allows you to invest every month, maybe 500 rupees or 1000 rupees, etc., etc. Land otherwise requires you to have some lump sum which is available, and then you invest. In the meanwhile, the lump sum, as it is getting created, it is only acquiring, maybe it's in fixed deposit, so maybe it is acquiring only 7-8%. But if you know a good asset instrument, which is real estate, which is called REITs, real estate investment trusts. If you know a good REIT performance, a good REIT which is performing that, invest in that. Or buy, if you want to buy into real estate, you can also look at real estate companies, let's say which are being freely traded on the stock exchange. They are better as an idea. So let's say, for example, you may have Shobha Developers, which is available. You can invest in that. Or there are those like Embassy. Embassy is a real estate investment trust, which invests only on commercial properties. So you can have a look at that and what is the kind of returns that they are giving. Not every real estate investment trust also will always be positive. And I had mentioned in the last one that if we look at ETFs, so there is a real estate related, there is no ETF which is currently available in NSE, in the National Stock Exchange. But I think Tata's or somebody, they're trying to come up with an index fund which will track the real estate index. So if you look at the in the last 1 year, the best real estate, the best index performance has been by real estate. Only last 1 year. Okay, it's not true prior to that, but it's been it's given more than 100% in the last 1 year. Okay, so you should either look at replicating that index yourself. You can buy the stocks which are present in that index, and then you can invest maybe 1,000 rupees, 2,000 rupees, etc., on a monthly basis. What I am clear about is that you know what helps in your returns or in wealth creation is what is the asset that you are choosing. That is extremely important. And then second is what is the discipline that you have in investing in it. Are you investing only once in 3 years, 5 years, or are you investing let's say on a monthly basis, or are you investing on a quarterly basis, 6 monthly, annual basis? Monthly performance is like monthly and weekly. I've done the analysis, is by and large same. So you don't have to stress yourself on a weekly basis. You can do it once a month, choose a day, or once or twice a month. You can have that as a strategy. But you should choose instruments which allow you both the flexibility of and the discipline. And definitely the instrument should be something which has given great returns in the past. Did that answer your question?
Yes, understood, sir.
Is there any follow-up question on this? Was it clear?
Yes.
Okay. So the next question is by Askar. It says, in the pension for life plan, I see capital guarantee plans and normal new fund plans. New fund plans show a return of around 18 lakhs per month, and capital guarantee plan gives principal amount on age 55 and returns at age 60 with pension 3 to 4 lakh per month. Okay. Calculated at investment of 7,000 per month for 10 years and maturity of 30 years. Both are market linked. Which one is the best choice? Okay, so two parts to this equation. So first, you should know what is meant by capital guarantee fund. What is the kind of a fund which is a capital guarantee fund, and what is a normal fund? Okay, so let me first answer this question before we can address which one is better. See, a fund can invest in pure equity, which means it could be investing in our large caps, which equity is basically what are the shares which are getting traded on the stock exchange. And it can also invest in instruments like bonds, okay, government bonds. So they will give maybe 8%, 9%, 10%, and so on and so forth. Or they can invest in gold ETFs or gold bonds, which are also considered to be defensive kind of thing. But fundamentally, when people say capital guarantee, what they do is they will park or they will invest. Let's say you are giving 7,000 rupees. So they will invest 7,000 rupees into, let's say, the capital markets. So they will buy Reliance, this, that, HDFC, and so on and so forth. They can be investing in large caps, they can be investing in small caps or mid caps. But 20% or 30%, some percentage, they are going to invest in your in bonds. So those bonds will give 8%, 9% return, and they design it such a way that even if, let us say, that 80% thing, that you have invested, you are investing, let's say, only for 10 years, right? So on over, just giving those 20% that is getting invested in bonds, and you get guaranteed 7%, 8%, over a period of 30 years, that will still give you guarantee of your capital. So it will give you a total, so 20% is getting invested, this 20% will become 5 times, and it will give you your guarantee your capital. And anything above that will be, whatever is the return that's coming from the market. That's how they are planning this. Is that a good idea? I don't think so. To put it in capital guarantee plans, it's fundamentally dependent on, and this is is it good or not? That only depends on the type of customer, right? Is, let's say, Mercedes a good car? It depends. The answer is, it always depends. Is MG Hector a good car? I bought the MG Hector, and it's a good car. It's not that great a car. I will give it away. Very, very soon I'll buy something which is cheaper and more flexible, and so on and so forth. So the answer to the question whether it is good or not is dependent on what you are looking for. What is your ability to absorb risk? Since most of the people on this call are quite young, I would say that you should not be looking at low or instruments which are called low risk instruments. If you want low risk, just invest in India. And investing in India means investing in the Nifty. So just pick a Nifty ETF, and it will continue to give you maybe 12-13%, something like that. Definitely for the next 15-20 years, I'd see no problem with respect to that. Now, that's my expectation. Okay, so I believe that India top Nifty 50 will grow around 12 to 15% per annum CAGR for the next 15 to 20 years. So my suggestion, and it, I'm not an expert on this thing, and I can't guarantee, because finally market is market. Tomorrow, who knows? What is going to happen? Is there going to be a war? Then who knows? And then all bets are off. But that kind of thing may happen even with, I'd address this question. Is a fixed deposit a guaranteed return? The answer is no, it makes no sense. For example, people in Argentina or Venezuela, if somebody had invested anything and they were getting an 8%, 10% return, if Argentina is having 100% inflation, that 8% return means nothing. So I invested 100 rupees, I will get 110, but there is 100% inflation, which means that whatever money I have today, it will become half in the next year. So I'll be left with only 55. So actually it is a depreciation of 45% rather than getting a 8% return. So what is it that I will, and I'm not a financial advisor, but I can share what I will do. Okay, so and then you can choose whether it makes sense for you or not. See, I think there is, our markets are quite good. We are not like China. They're fairly transparent, they're fairly well controlled. At least the large caps and the mid caps, they have sufficient amount of regulatory controls. India as a story is continuing to grow. Our population is going to continue to grow. So consumption will continue to grow. So I don't see any risk, or let me say, I see very limited risk if you invest in market-linked equity, and you get returns on that. So it will be called as wherever you will see, it will be called as risky proposition. What Chetan is saying is risky. But imagine this. Let's say it gives you 20% return, okay, over a period of 10 years. Now, even if sometime there is a fall in these mutual funds or ETFs, and they fall by, let's say, 20% or 30%. Worst case, I think we had a 40% fall during COVID. So let's say another 5 years, there's another some COVID which happens, and you have a fall for 1 year for 20%. India had even in the COVID year, there was only one quarter where we had minus 23%. But overall, we landed up with only minus 4 or 5% as India. And then after that, has been in up, has only seen an upward trend. So imagine this, that your 100 rupees that you are investing, they continue to grow for at 20%. Vis-a-vis, you have and then there's a risk that 1 year or 2 years it may get depressed by 28% or so. Is that a better proposition, or continually having 20% or 30% of whatever your investable surplus is into which gives you only a return of 7-8%? What is good? The answer is available to you. If you look at only pure return, then you look at what is the IRR and the returns that you are going to get over this. Take the amounts that you are going to invest of the funds that or the schemes that you are comparing, put the second one, and compute the IRR, internal rate of return. How to compute IRR? We had discussed in the second podcast, I believe, how to compute, and it is available on in Excel. It's a very simple one. You can do either an IRR or an XIRR, and both will work. If you know the dates when you are going to invest, choose that, find what the return is. But 20%, ये धोखा देने वाली बात है. So 20%, basically what they are saying is 20% they are going to invest in bonds. You might as well do that yourself. Buy bonds. Okay, so, and wherever you are taking the risk, try to get the maximum out of it. See, anything that they are saying that they are going to show a return of 18 lakhs per month or 3 to 4 lakhs per month is basis whatever they have done in the past. Now, you should take all of what they are saying that they have done in the past. You must verify it, whether that is true or not. Second, take it with a pinch of salt, because today, for example, as I said, real estate index fund has shown a 108% or 110% kind of return over the last 1 year. But that's not true for the last 5 years. It is only this year that they are given. Similarly, even if you look at the NSE this time, last year to this year, has given a National Stock Exchange or the Nifty 50. They have given a return of around 26% or 27%. That typically does not happen. So your expectation, every place where you are going, there would be people are salespeople. They will try to sell you whatever it is that they are saying, and it will be truth, but not fully truth. Okay, so it is not true that if some fund has delivered 100% or 80% last year, it is likely to do that forever or for the next 10 years. That's not true. So the fact is, every fund today that you are seeing shows an increased performance because the last year has been exceptionally good. So everybody is showing huge rates of return. So in case you want to look at performance, you should look at consistency of performance and then have the right expectation. The next question therefore comes is, how do you measure consistency of performance, right? Of a fund or an ETF? Yes or no?
Yes, especially in the case of the new fund, how we gonna measure?
Difficult. New funds, that's why I don't prefer, because at least the only way you can look at it is who is the fund manager, and look at the fund manager's past performance. It is only see, there are two kinds of funds. One is open-ended funds, and most are open-ended funds. Open-ended means people can come in and come out of it any time, right? So basically the asset value, the NAV, will continue to increase just like a stock every year or decrease, depending on the performance of the underlying shares that they have bought. Now, so one asset manager may handle only one fund or may handle a portfolio of funds, and typically they will use different approaches differently. So whatever new fund offering is coming, you should read that up and say, how are they going to invest? So it could be a small cap fund, for example, or it might be a strategy fund, which says, okay, this fund is going to invest in only those on the best performers of the top 230 of the top 200 companies which are traded on the NSE, and there are funds like this. I think what is that? Motilal Oswal has some fund like this. Similarly, Kotak has a fund which is called the Alpha Fund or something like that. So they will have funds like this. So you look at who the fund manager is and see what is in the performance, and believe that, okay, if this guy is doing it, he has done it, been there, done it in the past, probably this guy has the skill to deliver you great returns. But I'm not in favor of, as a person, I am not in favor of new fund offerings, because not enough is known. I don't have the past performance data. You want to take that risk? Feel free. But at least what you should do is understand what this new fund is going to invest in, what have similar investments given in the past, what is the benchmark index for this fund, and what has been the performance of the benchmark index over the past, and then take that choice. After all, this is your money, so. But I would rather invest in an open-ended fund which has a long track record and shows consistency of performance. So imagine this. Which is better for you? Somebody who gives you, today you are looking at it, somebody who has given one fund which has given 50% return. Okay, but over the past 5 years, it was giving only 15 to 18% return. But last year it has given 50% return. This is fund number one. And there is another fund which has been giving 25% return year on year for the past 5 years. Which one would you choose? Hello? Which one would you choose?
Sir, second option, your voice breaks, sir. I didn't hear second option.
Okay, so one option is that there's a fund which has given 50% return last year, and over the prior 4 years it was giving you 18% return, but last year has given 50%. And fund number B has given on an average 25% over consistently over the last 5 years. So around 25, 24, 23, 25, 26 and so on and so forth. For the last 5 years, average is 25%. By and large, it is it's hovering around 25%.
The second one would be
Yes, sir.
Wise.
Sir, option B will be a wiser choice, sir, because it has shown the consistency.
Right. So many fund managers will also look at consistency. Now, I have tried to find what is the consistency measure or index which is available. While I think Economic Times says that they find it, I haven't found it. So if you find it, okay, please share that, and also share that over on the YouTube channel. Send in the comment section. Leave it where you can figure out. You can give a linkage to how you can measure consistency. But what I have done is I have an approach which I have developed, which I'm going to share with you, and maybe it is going to be useful for you to make that choice, right? To measure consistency. Would you want to see it?
Sir.
Okay, so here is, I want to share my screen. Okay, my screen is visible. Okay, so first is, you should know where to go for collecting just hold on. Net asset values of mutual funds. Now, so this is NAVs, this website, which is Association of Mutual Funds in India. It is a good place where the past data is available. Okay, so you can click on historical NAV for a period, and then you can choose whichever fund, and then you can say it allows you can download the historical NAV for a maximum of 5 years at a time. So you can go back in time, 10 years and so on and so forth. You can go back in time. You would see that I've done that for January 1st January 2015 to 31st December 2019. I had downloaded. So you just click on this, it will come, and then you can do an Excel download, and it will store this here, and you can then open it. Okay. So anyway, I've done all of this. So you have the NAV, which is the net asset value, which is available as on that date. So I've already done that. So here is the price, which is on certain date, NAV date, and then I've captured the net asset value from 1st of, okay, so 2019 onwards it is available. And then what I've done is I've made a pivot of this. So I've done a year month so that I could sort it by month, and I wanted to see the value on a monthly basis, the average value on a monthly basis. I didn't want to compare on a daily basis. So I do have this now. So 1st of January. So this is the year in YYY and MM format. So 01 is January, 02 is February, 03 is March. So here the performance, the average net asset value from January 2015 to March of 2024, as we are currently doing. So what you will see, it began with 11 rupees and it has gone on to become around 45 rupees, 44.92 rupees as on March of 2024 average. Okay, so almost 4 times it has become over 10 years. So that's fundamentally good. Okay. Now, what I've done is I have tried to look at to compare. Let's say somebody gives a return of let's say 40% in after 5 years. Is that good? So if 11 rupees were to become 15 rupees or 16 rupees over the next 5 years, which is 40%, would that be a good performance? And the answer is obviously no, right? Why? Because if you look at this benchmark annual, if you look at just 7%, then 7% is what you get as almost risk-free from Government of India bonds or something like that. You will get this FD or something like that. So if you do this, then compounded just on 7%, after 5 years you will get a 40% return. Correct? Only on FD. Now, obviously I'm putting some money in the market, so there should be a gap between the performance that I'm expecting from the market, and I'm carrying some risk rather than let's say investing only in government bonds, which are considered to be almost risk-free. So I say, okay, there should be another additional 10%, additional 3%. So I should definitely get minimum of 10% compounded, and that would make it worthwhile. So then it means that after 5 years, I should at least get 61% return from my portfolio. That's what makes sense. Otherwise, I would rather invest over here. This is coming tax free. I'm happy with that. So this is here 5 years. Okay. So in most places, if you go to, let's say, Money Control or some places, they will give you performance as of today. Let's say, for example, I go to Money Control and say, go over here, and they say here, what is the performance? So they will show returns. It's going to show return. So if you look at the returns, what is this going to say? It is going to say, okay, what is the return over 10-year period, 1-year period, 2-year period, 3-year period, 5-year period? What is the issue with this? Why don't I like this? Okay, it is a good place to start, because They've done some computation, and it is a good place to start. So if today, for example, the performance is very, very good, suddenly last year something has grown tremendously, then even if the last 10 years were bad, against the last 10 years, the 10 year ago, 5 year ago, 3 year ago, 2 year ago, because it compares with the historic, with the NAV today, it will show, okay, performance is very, very good. So imagine that you get a lottery, and aapke sare guna piche wal, your past, all the crimes that you have committed, all of that is wiped off, with this kind of approach. And I don't like it. I want to measure something which will show consistency of performance, which means every year has it delivered me the performance consistently, or is it only something which has happened in the last year? Okay, so this is what I'm trying to do over here. So if I look over here, what I've done is this is monthly, the NAVs which are available, and then I have compared this NAV on a monthly basis for year 1 with the value which is 12 months ago. So this 64%, if you look at it, is comparing 44.92, which is March of 2024 with March of 2023. Similarly, this one is comparing February of 2024 with February of 2023, and so on and so forth. Okay. When I look at this 2-year performance, then it compares this with the period 24 months ago. Okay, so what was the performance 2 years ago? So it will say, okay, so it is comparing, current this month with March of 2022. So 2 years ago, it is showing what the value is. Okay, so it shows 86% increase, and this I do month on month. Similarly, this one is 3 years ago, so it shows what is 3 years ago, then 4 years ago, 5 years ago. So I'm looking at the past 5 years and then saying, okay, over the last 10 years, what has been its 1 year ago performance, 2 years ago performance, 3 years ago, 3 years performance, 4 years performance, 5 years performance over the last 10 years. So I see total periods for 1 year, it is 99 periods or 99 months, which is available. 87 for 2 years, 3-year performance at 75, and 51 months for where I can do a 5-year comparison. Okay, so then what I'm saying is what were the number of times that my money actually returned less than 0%? It fell below. So in the first year, in the last 10 years, there were, if you just do a 1 year comparison, there were 23% almost, or 24% of the times when you lost some money, which means actually that around 67% of the time you did not lose money. 2/3 of the time, there was no loss of money. But 23%, no, so I'm saying 77%, which is good. So 77% of the time it did not lose money. Then I'm saying, what is the benchmark plus risk, which is this 10%, right? How many times did it deliver lesser than the benchmark plus risk? So in the first year, the benchmark plus risk is 10%. In the next year, it is 21%. In 3 years' time, it becomes 33%. In 4 years' time, it becomes 46%. And year 5, it becomes 61%. So what do we see? So in terms of percentage, if you keep your money only for 1 year, then the return by this particular SBI, this instrument is where it has lost out against that risk or my expectation is about 40%. Okay, so 60% of the time it still gave me performance above the benchmark and risk, above the 10%. But over a 5-year period, only 25% of the time is it less. than the benchmark plus risk. So I have a 75% probability over a period of 5 years. If I keep my money for 5 years invested in this thing, where I have a 75% probability where I will beat the 10% CAGR. Okay, so there were only 13 instances where out of 51 where I delivered less than the benchmark plus risk. But remember this is an average of a month. Now the fact is you may not even notice a month. It might be just if you can do this similar kind of exercises with a quarter, and that may make even more sense, and then you will see that even the performance is far better. Because the fact is there will be times when in a month that a market will crash, for whatever reason. It gets some bad news, it crashes for a month, and then it will rise again, and so on and so forth. This is not meant for a trader. Remember, this is fundamentally you operating as an investor. Does it make sense?
Yes, sir.
Yes, sir.
So this was one instrument. Now you can compare this if you are choosing 2 instruments or 3 instruments, right? There are different schemes. You can see what their past performance is, last 10 years and so on and so forth, and see what is the kind of return, and say, okay, is this which one is the better performing one? Okay, so over a 5-year period, I did it only for 5. You can extend it for 7, 8, 10 years or whatever. You guys are young. I think 5 years is a good, or maybe 7 years is a good performance index, a horizon to have. And then whatever is doing well over a period of 5 to 7 years, and which has been consistently better than if you have 2 schemes, the one which shows better consistency, choose that. It's as simple as that. It consistently has lesser number of periods where it is lower, and the performance is higher than the benchmark plus risk. That's what I should choose. Okay. Any further questions?
No, sir.
So did you figure out how to measure consistency?
Haan, sir.
Abhijit, any question? So I would strongly urge everybody who is making some investments in mutual funds, and look at even retirement plans. So I'm a great believer that people should have investments in. First they should protect their health. They must have health insurance. If they are married and have children, dependents who are dependent on them, then they must take a term insurance. Once these 2 responsibilities are done, then you must ensure that you are investing and making your money work for you, so that you finally not working for money, but having money work for you. Become you are the master of your money rather than the servant to money. Your money decides everything. Your decisions. EMIs in general are not a great idea. I've been there and done that, but it was just because I was a financial illiterate. Okay, so EMIs typically make money for banks, not for you, and it is almost akin to let's say taking a loan and then investing in the market, assuming that if the market is going to give you a better return, why can't I take a loan? Take a personal loan at 16%. Market gives me 30%, so let me do that. Not a good idea. Not a good idea at all. So the best is you have some investable surplus, you create some investable surplus, and then invest in instruments which are likely to always go up. Everything which is available on as an asset class has certain risk, but you should have the ability to figure out what is the ability to take risk. Now, risk is fundamentally probability. Over the last 30 years, have there been times when the market has gone down? Yes. Months? Yes. When India has gone down? Yes. But over a year, has it gone down? Every year it has increased. Only with the exception of the COVID year, where our economy contracted for whatever decisions were taken, or whatever it is worth, it contracted about 4-5%. But after that, apart from that exception, it's always been growing. So that's why I would invest in. I am investing in my investable surplus in India, in instruments which I believe will give a high probability of returns. These are not retirement mutual funds, but simply others, where I have some bit of control. But have a look at this. The retirement mutual funds don't give. There are no taxes on that, and that's fine. I think till about 2.5 lakh rupees, you can invest in any retirement mutual funds per annum, and it will not attract any taxes because of something called Section 1010D of the Income Tax Act, and you can have a look at and study it. If you go beyond 2.5 lakh rupees, then any return on that amount, which is more than 2.5 lakh rupees, will also attract taxes. Okay, so fundamentally, I think what you should do, as I said, you should evaluate what is the taxability, also what is the cost of various instruments. You will have multiple options, and when we were doing the third session, we had talked about how to go to NSE India and see which are the ETFs which are performing well, how to go to money control and see which are the mutual funds which are performing well. Now you will make some choices. You will select 2 or 3 from that, or maybe 5 of that, and then take out their historical records and figure out what the consistency is, as I showed over here. And then you will deploy your risk, divide your risk, and choose to divide over the top 3 or 4. And so if you have 7,000 rupees, you will deploy it, maybe 2,000, and 1,000 over 3 or 4 instruments. So that even if one, for whatever reason, performs poorly, it is unlikely that all the top 3 top performers will stop giving you returns and will fare poorly. But know this: there is no instrument which always consistently increases. Only those instruments are called zero risk. Those zero risk instruments are government bonds, which will give you a return of 7 to 8%. That's all. But that's also inflation. And some people say actually inflation is shown as 4 to 6%, but as actually around 9% or so. Even if you're getting 7-8%, and if the inflation is 9%, then you are actually losing money. Okay, not at the rate that Argentinians lost money, because they had 100% inflation rate, or as Turkey lost money, which was again 70-80% inflation rate, or as Pakistanis are losing money. But you will lose money. So FDs are not a great idea. You will need to take some risk. You are young, and this is hardly any risk. It might say some year it will go down, but India will continue to grow, no doubt about it. Okay, any question? Last ones? Okay. Raja, any question?
Sir, whatever you are saying, everything is fine, sir. I am accepting 100%, more than 100% true. But if anybody want, can I tell my suggestion, sir? Because
Sure.
wherever I failed, that will be helpful for the new investor. Yes. So if anybody wants to invest money either in gold or real estate or market, so that that answer also you provided, because you don't go with EMI like that. Don't get a loan and don't invest it. That is the way we supposed to think about it whenever you want to invest. So how much money currently you have? Today you have this much money. Tomorrow you have more than this much money. So don't lock your money to anywhere. So for example, this is my suggestion. If you want to go for the retirement, your money is always lacking. Now you was a 7,000 rupees you are paying per month. Tomorrow you may have a 70,000. So why are you go with like that? Think about it current situation, invest it in the broadly. If you don't have money, you can save 7,000 na. We have a multiple sector available in the stock market. You can invest in multiple places, either in the media, either in the petroleum, either in the different different sector is there. So invest broadly. There are all are available in Nifty itself. Nifty gold is there, Nifty is there, Nifty petroleum is there, Nifty IT is there. Invest it spreadly. Don't worry about it. How much money you are getting, earning this. Wait for some time. You will get some amount. Whenever the market crashes, take it all the things. Invest. By the way, you have to look into that all the sector. Then invest it. Then this is how your money has to be run all the time. Do not lock any time. At least single year also do not lock your money. Rotate it. You will get some lump amount in that whenever you wanted it. Once you get it, then you decide it that if you want to go for real estate, take it, invest it without any loan. So
Yeah.
that forget that money.
Loans are not typically a good idea to invest in, and especially in land. So, as I said, I had also done something similar. I thought I was investing. I'd paid large EMIs, large amounts of EMIs for almost a decade or so, and then I sold houses also. So, and from one point of view, I would have made money, but I paid zero taxes on it. You know why? Because when you look at land or when you sell it, then there is something called indexation. So let's say I doubled the property value when I sold it. But imagine that I bought something for 5 lakh rupees and then I sold it for, let's say 15 lakh rupees. But this was over a period of 10 years or 15 years. And I paid zero tax. Why? Because that 5 lakh rupees, even by the government of India, should have become, around 17 lakh rupees. So they said the actual cost is not 5 lakhs because they're comparing the price today with the previous, the past. That's not a good idea. So they said, what was the value of that 5 lakh rupees? What would be the value of that 5 lakh rupees today? So that became 17 lakh rupees. I had got only 15 lakh rupees after paying all my EMIs and so on and so forth. And, I actually, therefore, as far as the government is concerned, I made a loss. I incurred a loss of 2 lakh rupees. Now, if I had done 5 lakh rupees, invested 5 lakh rupees, and it was getting, let's say, 20% return or 25% return, as 20 to 25% return, definitely the value of that would have been more than 15 lakh rupees. No doubt about it. So you should do your mathematics. Mathematics is good. See the compounding, the CAGR that you are likely to get. Real estate typically it will give a defensive rate of return, just like gold. It will give around maybe slightly better, maybe 10-11% kind of return in comparison to the 7-8% that the government bond gives. Okay, but EMIs are not, taking loans to buy houses, etc. is not a great idea. You can do it, but it will not give you. There are better instruments which are available. If you have a ghoda, if you have a horse, why do you want to buy a donkey? If there's an option of a horse, why buy a donkey? Yeah, it's simple as that. But there might be some things where sometimes when you want to buy a donkey, what a donkey can do, a horse can't do. It won't take your clothes from one place to the other, or travel up the mountain. You want donkeys only. So it depends on what purpose. But by and large, choose a horse than a donkey. Okay, Surya Jaswees, I hope this was useful for you. If there are questions, which come up, please do. This was the last session on the wealth series. If there are questions, go and go to the YouTube channel, post your question on the comment section. You can comment on it, and I will definitely address those questions. Okay, to the best of my capability. I wish you all a lot of light and love and happiness. May you be successful in whichever way you define it, but definitely gain freedom. Gain freedom from the need to work for money. Be the master. Be wealthy. Cheers. Bye bye.
Thank you.
Thank you, sir. Surajaswini Master.
Surya Jasmine.